Just wanted to put a short video together about a valuation we just did recently. So this was a software as a service business. Basically, it was a crowdsourcing platform, a company that sort of in the realm of an Upwork. I thought this is a pretty interesting industry. We get research from IBIS World, and what they said about the crowdsourcing service providers industry is that it's grown 20% every year since 2005. And that they're expecting annualized growth of 37% to $1.4 billion in this year, 2017. And then they're expecting the industry to grow over 25% going forward. So this is obviously a high growth industry. There's a lot of very innovative, interesting companies providing software services, freelance services, micro tasks, ideation tasks. They mention, obviously we know Elance, which was acquired by Upwork. But, in valuing this business is a little bit of a challenge, which I think most, anyone in kind of the software tech world can appreciate is when you're dealing with a very high growth business where there's a lot of potential in the future, but currently the company has very little to no revenue at all. I mean, last year the company did less than $100,000 in sales and was not profitable. So how do you value a business like that, right? I mean, that's the real challenge. Going forward, they're projecting very significant growth, but it may not happen at all. So, these guys are looking to raise some money for the business. The growth may or may not materialize. So again, how do you value a business like this that has significant growth potential, but today doesn't really have very impressive results if we're just looking at the numbers the way they are? So, what we did was we built a projection model, and we used a discounted cash flow valuation, a 5-year discounted cash flow valuation. We took a discount rate of mid 30% range, and that was based on, that's basically a weighted average cost of capital analysis we did for this business. But yeah, I mean, that's not as important, but, it's a pretty significant discount rate because even though we're projecting 100% plus growth annually going forward and fairly significant profit margins, 20, 30 plus percent sort of profit margins for this business, we're discounting those projections every year by more than 30%. So when we came back to the numbers, the final result of our model showed the company is worth about $1 million, and the owner was comfortable with this valuation. This was about the value that they had raised capital in the recent past. And he did express concerns about their ability to raise capital. They hadn't done that recently, even though they'd made some attempts to do so. Also, we looked at comparable transactions of other companies in the software services industry, software as a service. So these companies are, if we're looking at deals in the last 2-3 years here, on average, these companies, and obviously the size matters as well, but we're looking at a sales multiple about a little over 2 times sales on average for these businesses. So, all in all, I mean, this was an interesting project and a little bit challenging from a valuation point of view, but, obviously, I mean, the discounted cash flow is where you have to go when you're really just looking at the future and you're not really looking at what's happening right now in the business, but counting on the future being bright and strong growth and profitability in the future. So anyway, I hope this was interesting to you. Thank you.